Target presented earnings earlier this month, where they missed on EPS and revenue. For the upcoming earnings, all analysts expect another miss. And as a result, the stock went down over 20% recently, which is a really big drop, of course, which is not the first time this year. So the question is, what happened at the recent earnings, and is there an overreaction right now? Let's find out in this video. So as mentioned a second ago, Target missed on earnings in the recent quarter. Looking at the actual numbers, we see that total revenue was reported at 25.6 billion, up 1.1% year over year. However, cost of sales is increasing at a slightly higher 1.2%. Operating income is also down, and what concerns me is that it is down 11.2% year over year. Down the line, this results in EPS going down roughly 12%. Looking at the dividends, we see that those were actually increasing 1.8% year over year, which is very nice, of course. And they are covered very easily with the recent earnings, so that's the silver lining here. Some other really interesting numbers are the comparable sales. For Target, it is really easy to generate more revenue by opening a new store. So you want the existing stores to grow as well. Looking at the store comparable sales, we see that this is actually decreasing at 1.9% year over year. Quite concerning to me. However, the digital comparable sales is increasing at almost 11%, which is very nice. Looking at the investing activities, we see that expenditures for property and equipment is much lower this year, resulting in more cash, which can be used of reduction of long-term debt, which is exactly what they did, which is very nice. Down the line, Target is left with more cash year over year, which is a positive sign to me. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Target is a 59 billion market cap company, making them one of the biggest retailers in the world. PE ratio is at 13, indicating that they are undervalued. But hold your horses. Target is a slow growing company, so we have to factor this in. Later in this video I will show you my 3 price targets for Target stock, so make sure to watch until the end. Revenue is at 107 billion, and in this graph we see that revenue went up in the long run. But recently they are struggling with getting that revenue up again. And with the revenue slowing down, it is extremely important that margins are increasing. And to be honest, this is a bit of a roller coaster. It is increasing, don't get me wrong, but only after a really big decrease. So keep your eye on these numbers, because in the recent earnings report we just discussed, we saw that margins were decreasing again. The EPS is having the same pattern, so nothing really special to add here. Analysts expect that in the coming years EPS will recover. From 2025 on, it is expected to see higher growth numbers every year. And to be honest, this looks pretty good to me. For the revenue, it is also looking pretty interesting, since they need a bit more time to see some growth according to the analysis. But from 2026 on, it is expected to finally see some growth again. Return on assets is sitting at 8%, which is a decent number. Return on equity looks really good, and the most important number, return on invested capital, is sitting at 12%, which is a great number. It is lower versus the 5-year average, which is something that I don't like. Current ratio is at 0.9, which is a great number. Nothing really special to mention here, to be honest. And right now Target has 19 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. They have 3.5 billion in debt, so they can't pay down a big chunk of their debt. So this is something that I don't like at all. The fact that they are paying down debt, which we saw in the recent earnings, is the silver lining. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run, but it is never at a steady and consistent pace. Shares outstanding are decreasing, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 3.4%, which is a great number. Annual payout is at $4.48. Payout ratio is around 47%, which is looking pretty good. There is plenty of room to grow the dividend, but also to grow the business. The 5-year growth rate is at 11%, which is really impressive. On top of that, they have increased the dividend for 56 years in a row. In here, we see that Target did increase the dividends at a decent pace historically, and in the recent years, the pace increased a lot. In this graph, we see the expected dividends in 2025, 2026, and 2027. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at a decent rate from here. And overall, these dividends look really good to me. But how about the historical returns? I decided to compare Target stock with the overall market. In this case, the S&P 500. Next to that, I added Walmart and Kroger. On the 5-year chart, we see that Target massively underperformed the overall market. And keep in mind, this is including dividends. Both Walmart and Kroger outperformed the S&P 500 big time, so there's a big difference here already. On the 1-year chart, it is no different with a shy 2% return for Target, while Walmart is crushing everyone in this list with a 73% return. On the 6-month chart, it is again the same story, and this time Target is actually at a negative 11%, while Walmart is again crushing everyone in the list. On the 1-month chart, we see that returns went even lower due to the recent earnings report for Target. Walmart is again the winner here. Bottom line, in the past 5 years, both the S&P 500 and the two competitors were the better option. And with Target hammered down a lot, could this be the perfect time to buy the stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 2, 3 and 4%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm putting in 3, 4 and 5%. For the free cash flow margin, I'm putting in slightly higher numbers. For the P/E ratio, I'm putting in 12, 13 and 14. For the price to free cash flow, I'm putting in the same numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, Target stock is around $127. I hit analyze, and we see a few green numbers. We have a low price target of $70 to $94. We have a mid price target of $105 to $131. And we have a high price target of $145 to $175. And I'm going to aim for the mid to high price target here, indicating that this stock could be undervalued. But again, hold your horses. This means the company should be growing in revenue and improve their margin. Both things are currently not the case. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Target is that it is a great company. It has been around for a really long time and the dividend track record is really impressive. The fact that they are able to increase it at a really high pace is also impressive. And last but not least, it's a 3% dividend yielder after the recent stock price drop, which is great. However, the company is struggling in a lot of areas. Revenue is slowing down and margins are taking big hits. This results in really low total returns for the stockholder, especially if you look at Walmart and Kroger, who both crushed targets. For now, I think it could be an interesting play, but the question is when to really start buying. The fact that the mid-price target has a bottom of $105 means that I'm going to wait a little longer before I'm buying this stock. I think there's plenty of upward potential as long as they are starting to grow again. For now, I'm putting them on the watch list and keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.